What if I told you that 97% of dividend investors are making their lives unnecessarily complicated? Harry had 47 different dividend stocks and ETFs in his portfolio. He spent 3 hours every week just tracking them. Then he discovered something that changed everything. He could get better results with just 4 holdings, not 40, not 14. 4. Most people think building dividend wealth requires dozens of positions. They collect dividend stocks like baseball cards. They chase every new high-yield opportunity. They constantly adjust, rebalance, and second-guess. But after analyzing thousands of portfolios, I found something fascinating. The most successful dividend investors keep it simple. They own a core group of holdings that work together like a machine. And today, I'm going to show you the only 4 dividend investments you might ever need for long-term wealth building. These 4 create the perfect balance of yield, growth, and stability. They cover every market sector you need. They compound wealth automatically, and once you set them up, they practically run themselves. Quick note: this is educational content about investment strategies. All investments carry risk, and past performance doesn't guarantee future results. Here's what we're uncovering today. First, the perfect dividend core that institutions quietly accumulate. Then the growth compounder most people overlook. Next, the high-yield anchor that pays like clockwork. And finally, the aristocrat builder with a twist nobody talks about. Let me show you why these 4 could beat everything else. 6 months ago, Harry was drowning in complexity. His spreadsheet had 47 different holdings. Some paid monthly, some quarterly, different ex-dividend dates, different tax implications. He thought diversification meant owning everything. Then he ran the numbers. Most of his ETFs had 60 to 80% overlap. He was paying multiple expense ratios for the same stocks. His diversified portfolio was actually concentrated in the same companies, just packaged differently. That's when everything clicked. SCHD, the perfect core foundation. The first investment changes everything about dividend investing. SCHD isn't just another dividend ETF. It's the backbone of lifetime passive income. While everyone chases the highest yields, SCHD does something different. It screens for quality first, yield second. The fund currently yields 3.75%. That beats inflation. But here's what makes it special. The dividend has grown for 13 consecutive years. Not many ETFs can claim that consistency. The 5-year dividend growth rate? 10.87% annually. Think about that for your retirement savings. Your income grows 10.87% per year while you sleep. Harry started with $10,000 in SCHD. At this growth rate, his annual dividend income doubles every 7 years. But the total return tells the real story. Over 5 years, SCHD delivered 72.69% total return. The expense ratio? Just 0.06%. That's $6 per year on a $10,000 investment. Here's what most people miss about SCHD. It only holds 103 stocks. That's concentrated enough for impact, but diversified enough for safety. The top holding, AbbVie, represents just 4.52% of the fund. No single company can sink your portfolio. The methodology is brilliant. SCHD tracks the Dow Jones U.S. Dividend 100 Index. But it doesn't just pick high yielders, it screens for companies with 10-year dividend track records. Then it ranks them by cash flow to total debt, return on equity, and dividend yield. Quality metrics first, yield last. That's why SCHD holds companies like Home Depot at 4.28% and Chevron at 4.41%. These aren't speculative yields. They're sustainable cash machines. The sector allocation provides true diversification. Energy at 19.77%, consumer defensive at 18.68%, healthcare at 15.88%. This isn't tech-heavy speculation, it's balanced exposure to sectors that weather storms. Harry made SCHD his largest position, 40% of his 4-fund portfolio. But income investors need growth too. DGRO, the growth compounder. Here's what surprises people about dividend growth investing. The best total returns often come from lower-yielding stocks that grow their dividends aggressively. DGRO proves this perfectly. Current yield, 2.04%. Most income investors would scroll right past. That's their mistake. Because DGRO delivered 94.37% total return over 5 years. That crushes the S&P 500's dividend yield while providing growth. The fund holds 405 companies focused on one thing: consistent dividend growth. Look at the 5-year dividend growth rate, 6.87% annually. The 10-year rate is even better at 8.91%. Your income stream compounds faster than inflation erodes purchasing power. The expense ratio matches at just 0.08%. With $34.28 billion in assets under management, DGRO has institutional scale. This means tight spreads, excellent liquidity, and low costs. But here's the real magic of DGRO. It captures dividend growth at the perfect moment. Companies that have paid dividends for exactly 5 years. Old enough for stability, young enough for growth. This sweet spot is where wealth building accelerates. The sector allocation tells the story. 20.36% in financials, 18.99% in technology. These aren't your grandfather's utility stocks. They're modern dividend growers like Microsoft at 3.02% and Apple at 3.09% of the fund. The top holdings reveal quality. JP Morgan Chase at 3.12%, Apple, ExxonMobil at 3.04%, Microsoft. These are dominant companies with moats protecting their dividends. Harry learned something crucial here. A 2% yield. Growing at 8% annually beats a 4% yield with no growth. After 10 years, the growing dividend pays more. After 20 years, it's not even close. Compound interest changes everything. He allocated 25% to DGRO, but sometimes you need income now. HDV, the high-yield anchor. This is where investment strategy beats emotion. HDV yields 3.09% currently, not the highest yield available, but it's the highest quality yield that's sustainable. The fund focuses on just 82 holdings, extreme concentration by ETF standards. That concentration is the point. The top holding, ExxonMobil, represents 8.70% of the fund. Chevron adds another 6.63%. When energy pays dividends, HDV shareholders feel it immediately. Over 5 years, total return hit 84.28%. But HDV serves a different purpose in the 4-fund portfolio. It's your income anchor. When markets drop and growth stocks cut dividends, HDV's mature companies keep paying. The proof is in the consistency. Even during market turmoil, HDV maintained payments. The expense ratio stays low at 0.08%. You're paying $8 per year per $10,000 invested for institutional quality dividend income. The sector allocation reveals the strategy. 25.14% consumer defensive, 22.29% energy, 19.84% healthcare. These sectors pay dividends through recessions. People still buy groceries, fill gas tanks, and take medicine when stocks crash. Harry noticed something interesting. HDV's holdings rarely overlap with SCHD or DGRO. Different selection criteria, different companies. True diversification across dividend strategies. Johnson & Johnson at 6.14%, AbbVie at 6.01%, Procter & Gamble at 4.70%. These are aristocrats that have paid through every crisis. He put 20% in HDV for immediate income. But the fourth investment surprised him most. SDY, the Aristocrat builder. Everyone knows about dividend aristocrats, but SDY approaches them differently. Instead of requiring 25 years of consecutive dividend increases, SDY demands 20 years of consecutive payments. Period. This captures a different group of companies. Current yield, 2.62%. Expense ratio, 0.35%. Higher than the others, but still reasonable. The 5-year total return, 75.06%. But the consistency record stands out. 17 years of consecutive dividend payments to shareholders. Through 2008. Through COVID. Through every market crisis, SDY kept paying. The fund holds 152 companies that have survived everything. What makes SDY special isn't the yield, it's the weighting methodology. Instead of market cap weighting, SDY weights by dividend yield. Higher yielders get bigger allocations. This creates natural rebalancing. When a stock's price rises, its yield falls, SDY automatically reduces the position. When prices fall and yields rise, SDY increases allocation. Buy low, sell high, automatically. The top holdings tell the story. Verizon at 2.73%, Realty Income at 2.50%. The monthly dividend REIT that's paid for 636 consecutive months. Boring? Yes. Reliable? Absolutely. The sector allocation emphasizes stability. 18.25% industrials, 16.62% consumer defensive, 15.14% utilities. These sectors don't make headlines, but they make dividends. Harry allocated his final 15% here. The four funds work together like gears in a machine. SCHD provides core quality income. DGRO delivers growth for future wealth. HDV anchors current income needs. SDY adds Aristocrat stability. Total portfolio yield, approximately 2.8%. But yield isn't everything in financial planning. The combined dividend growth rate approaches 8% annually. The blended expense ratio, just 0.13%. You're paying $13 per $10,000 invested for complete dividend exposure. Harry's results after switching to 4 funds? His tracking time dropped from 3 hours weekly to 15 minutes monthly. His dividend income actually increased 12% in year 1. The overlap between holdings dropped to under 20%. But the biggest change was psychological. No more FOMO when a new dividend stock trends. No more constant rebalancing. No more analysis paralysis. Just 4 funds doing exactly what they're designed to do. The allocation formula works like this: 40% SCHD for core dividend growth, 25% DGRO for aggressive dividend growth, 20% HDV for current income, 15% SDY for Aristocrat stability. Adjust based on your situation. Younger investors might increase DGRO to 35% and reduce HDV to 10%. Retirees might boost HDV to 30% and lower DGRO to 15%. The framework adapts to your financial goals. The compound effect changes everything. Starting with $100,000 across these 4 funds, assuming historical dividend growth continues, your annual dividend income could reach $8,000 within 7 years, without adding another penny. Reinvest those dividends? The snowball accelerates. Each payment buys more shares. More shares generate more dividends. The cycle compounds wealth automatically. Harry's complex 47-holding portfolio became 4 simple positions. His stress disappeared. His returns improved. His confidence soared. Because he finally understood that wealth building isn't about complexity. It's about owning quality and letting time work. These 4 dividend investments provide everything: growth, income, stability, and simplicity. They weather crashes. They compound through booms. They pay through everything. The question isn't whether this strategy works. The question is when you'll start. Because every month you wait is another month of compound growth lost, another month of passive income streams missed, another month of wealth building delayed. Harry's only regret? Not simplifying sooner. The 4-fund dividend portfolio isn't just an investment strategy. It's a wealth-building machine that runs itself. Set it up once. Let it compound forever. That's the power of simplicity. That's how you build dividend wealth for life.